Good morning, welcome to this morning's webinar, Saturday's Traders Club. So, just to remind you, obviously, if you're watching this from YouTube, it will be available live later, so it's up to you how many notes you take, but here we go. The purpose of Saturday Club is really to share ideas, get people discussing trading a lot more, rather than it just sort of being dictated by me as a trader. So it's really up to you guys what you would like to see at future webinars. I would cover basically anything. There will be subjects chosen by you guys. This one is someone that had actually chosen today's subject, so I'm only covering what's been asked for effectively. It's a great place to share experiences. You can obviously type away in the alternative chat boxes, so you can chat away. So if you want to share experiences, feel free to do so. I'm not totally focused on Forex, so if you want to look at equity markets, anything basically, maybe even the occasional Bitcoin view, or crypto view, should I say. Anyway, so it's wide open, so it's just a reminder really what sort of things we're covering here, so you can chip in with your own ideas for the future. So today then, this month is well, we're looking at backtesting. This is the agenda for this morning. I'm going to be looking at backtesting, and I'm going to show it combined with a specific strategy, or parts of a strategy. You can build and develop it as you would like. I'm looking for requests for next month, so you can do that after the event. I'm not really too worried about that, and of course there'll be a Q&A at the end. The idea is that we pitch these into about an hour. As we go through the summer, I'll take a sort of a stab of how many people are really wanting it, and it may be that it sort of restarts post summer, but for now, here we go. So backtesting was the main subject asked for. So of course, where do you start when you're backtesting? What's if you want to test a strategy or you want to do something? It all starts with the idea, the observation of what you've seen on the charts. I would suggest if it's a technical observation or an idea, maybe I don't know, a fundamental idea that you might have outside of that. But generally, most trading tests are done basically using charts. So it'd generally be a technical observation. So you've got to decide on whatever that is. What I'm going to do as I go through here is just give you ideas. I'm tying this to a video I did just the other day on the pivot, simple pivot strategy. So I'm going to just bring charts into play, and we will look at, there we go, and we'll look at the principles behind something. So the principle behind the pivot strategy is, for example, that there's let me just get my pen. There we go. So it's a statistical basis that on a daily basis, when we're looking at pivots, either the R1 or the S1 has a very high probability of being hit, either one of them. It's over 80% chance of one or the other being hit. So that's the basic premise behind this, the idea behind this. So if that's the case and it's as high as 80%, then it's a case of looking at other factors. But that was the main thing. Now you can go back and watch the video. It's on YouTube if you wish. It's called a simple pivot strategy. And it's there, so I'm not going to go into great detail on the strategy that I say the principles of the strategy. So there's the basic idea behind this. It's an observation maybe, but well, in this case it was a case of looking at some stats and winding back, and I did complete stats of pivots and looking at the potential or the probability of each of the R1, the R2, etc. being hit, and then worked from there. So let's just move on. So that's the first step of things. Then we've got he says. Then we've got the reasoning why it might work. Well, in this particular case, it's quite simple. I think it's important that when you're testing something, you understand why it could happen, why it could work. Like a divergence. Why would a divergence work? Why would that create an opportunity? And so that's the sort of starting point. And then you've got to have that understanding with this pivot strategy. Well, the basic reason why it works is a statistical reason. So we've got a reasoning behind it, because otherwise you're just clutching at straws. It's as I say, it's the foundations of what you're looking at is really important. Then you start off with some initial rules. You start hanging some rules about it. Now you got to backtest anything. You've got to have rules, and they become really quite strict in terms of what they might be. Because if they're too loose, well, it's a difficult one. I mean, this particular strategy has an element of looseness, as I call it, in it. But I'll show you some ideas about how you might address that. There can be sort of set looser rules, which will be up to you basically, but at the same time the main principles will still be set. When you start looking at taking something, you've got to understand what you're going to measure in terms of columns. If you do it on a spreadsheet, I'm going to go to the next point here. I do a quick what I call a Q&D, a quick and dirty. Basically, I take a sheet of paper and I start looking at the strategy. So let's come back to the strategy. I come back, if I can bring the chart back into play. There we go. So I come back, look at what I'm talking about. So it's got, okay, and then I build some things up. Firstly, it's got to have hit the main pivot each day. So I start building something up from there. It's got to have hit the main pivot. It's got to have a reasonable target either side. So if the pivots, if the R1 and the S1 were effectively below the average true range of that time frame, I wouldn't be interested, because it'd be so tight. There wouldn't be an opportunity. So it's got to have a reasonable. But reasonable, what's reasonable? Well, we'll come back to that bit in a moment, because when you start doing the Q&D on this, you actually start building up an idea. Well, I'll share the reasonable at the moment. I would suggest something's got to have at least a multiple of 1.1, 1.2. So even if you've only got a 50% win rate overall, you're still going to edge out a bit of money. So I would suggest something like that. But I would look at it in multiples. I would never look at things in points, because it's a major variable when you start looking at points or percentages. So it would always be calculated based on percentages. Percentage of risk versus the percentage of opportunity. So you get that nice risk-reward balance. Okay, so as I say, going back, building the rules. Well, obviously we're looking at the R1 or the S1 as targets. Do I only take trades, and in this particular case, do I only take trades? Well, this is going to be a question when I'm doing the Q&D, the quick and dirty on it. Do I only take trades that have got a trend leading into them? I.e., if the trend is up, I'm only looking for the long side of things, and that could be a question. And it's because it's a question at the outset. You can actually write this down and measure either way. So it gives you two things to quickly measure. You can either measure it as a immediate do I select only those in trend, so prior price action must be in trend, or do I say, well, actually no, I'm quite happy taking the other side of the move, like here. there's no real trend at this one here, but obviously it pitched up this way, and again no trend here. So what do I do when there's no trend? So you've got to consider those sort of things and measure and tick boxes to say yes, they're in trend, they're in because when it's doing this, so the market's in a bit more of a chop, do I still take them? And if you're measuring them at the early stage and you start putting these things down, you'll soon see whether it's working or not. And if it's not working, you just sort of stop measuring it basically eventually. So that's where we are. As I say, build up more rules. I'll have a time rule. I think I might have even included that. I have. I'll come into that later, but you should measure the time it kicks off. I'll talk about time rules in a moment, but you need to know what time it's going. So when you're measuring things, the time, the day of the week, even sometimes it may be more interesting. I've got one strategy that I do not trade on the Canadian dollar on a Friday. Why the Canadian? Well, it's just I only trade it over 3 currencies, and I just do not trade that strategy on that currency on a Friday because it's got such a high rate of loss on a Friday for whatever reason. It might be because we have a series of news events that come out like non-farms on one Friday a month or whatever. But either way, I discount it on a Friday, and then I'll have time frames which I trade elsewhere. So if you're measuring these things and measuring them really quick and simply, as I say, Q&D, quick and dirty, just get it written down there. Once you start doing something like this, you soon start building questions, and you might say, well, I need to measure a few things. But if you're only testing initially, 10, 15 results, it'll build up. You'll soon see what you need to measure. But you need to. It's a bit of chicken and egg. You need to start doing some of the testing before you realise the sort of factors that you'll build into it. But I'll give you some factors anyway as we go through this testing. Right. Okay. So one of the most difficult points for people when they come to backtesting is that option between mechanical or discretionary. What I'm looking at with this little pivot trade has a partial discretionary aspect, so it's not totally mechanical. Could I then stick it into a machine and or any sort of backtesting tool? No, is the answer. It's not going, or not easily. I'm sure someone with a lot more knowledge of backtesting or these tools could do. Someone, a quant scientist or something, I'm sure they could work out a basis of doing it, and perhaps there is something a bit simpler, but in general terms, because it could have about 3 or 4 different types of entry, it makes it quite difficult for a normal backtesting tools to do it. However, the main principle behind it, the first parts of the rules are quite solid and they're quite mechanical, so I could build it up and I could maybe set alerts for it or something, but some strategies are absolutely ideal for mechanical. For example, if you're just looking at candle patterns and maybe moving averages in relation to those candle patterns at the outset, but you've got to be careful when you do anything with moving averages on a backtesting basis, because the moving averages move, and depending on the quality of the backtesting tool, they might or might not work properly. So you've got to be a little bit careful. You've got to have rules about where your stop placement is. There's no point just having this sort of loosey-goosey sort of ideas about, well, if it does this I'll do that or whatever. It's got to be an absolute rule of where you're placing the stop before you go back and backtest anything at all. You've got to have a strict rule. It might be you change that rule, but you've got to kick off with something that's pretty strict, because otherwise it becomes, well, if it does this I'll do this, and if it does this I'll do that. You've got to have it that you know exactly where things are going to be. Then you've got to have entry rules. So how do I get in the position? When I come back, I'm going to run through these rules and then come back to the example. I think it might be easier. So the entry rules themselves. How do I get into the trade? What's the criteria? Is it a break of the top of a candle? Does it need to be 1 or 2 pips above that candle to make sure I don't get tricked over into the next period, because what we see, particularly on the hourlies, I study hourly candles a lot, and you often see this sort of move. The first candle comes in, it might be the setup candle, as I prefer to call it, and then you might get the entry candle coming in next, and it might just go slightly beyond the setup candle, just fractionally. And you might notice this over a number of, and this is where backtesting itself comes in. You realize that, well, actually I only moved a pip above, or 2 pips above, and then it failed, and I could rule out X amount of losing trades by saying, well, okay, I'll only take an entry 3 pips above, 2 pips below, or something like this, to take into account the spread, of course. Trading times. I sort of hit on this a short while ago, but trading times are very important in when you come to a strategy. Now, because I'm a sort of London time-based trader, I'm looking at London times, and I'm not going to be wanting to, unless it's an automated system. I don't want to be getting out of bed at 3 o'clock in the morning to go and place a trade, and I don't want to be sitting at my screens at 9, 10, 11 o'clock at night. If the amount of time I've got available personally, it means that, well, I've only got X amount of hours in the evening to trade, or in the early mornings, well, then I have to fit it around. But for me, when I'm building my trading times, they are quite specific, and they are slots. I've always already said about not trading Fridays on some days or whatever. I will not trade at certain times of day. I do not like trading before 8 a.m. in the morning. I don't like. Why do I not like it? Because the probability, the volumes, and everything else for most of my strategies just don't come into play. But it might be you've got a little strategy that fits 7 o'clock, 6 o'clock, whatever it might be, and it works perfectly. And when we go back and we'll have a look at the putting this together on the example, you'll see that well, you know, sometimes the setups came absolutely perfectly and went before my trading times. But unless I've got it automated, I'm not going to, as I say, sit there sort of 24 hours a day looking at screens. The idea is to make things simpler and just have a real good understanding of what you're trading. So trading times, and it may, as I said, 8 o'clock is my starting point, 3 o'clock is probably my ending point in terms of taking trades. So it doesn't mean to say I won't be in a trade. If I'm swing trading on different strategies, yep, I can be taking those anytime they set up. I might just put a buy stop or sell stop in for something like that. If I'm setting up a shorter time day trading type strategy, then I'll be looking at the times of the day I'm actually taking the trades on. And I think that it does vary in terms of what you're doing. You've got to be careful, even on swing trades, that you'll see sometimes the market can move 30, 40, 50 pips sometimes through the Asian session and then go completely reverse back again. So you might want to be sort of trading in a time that suits you, and even taking the trades in a specific time. So mine's always taken in a specific time. Now I'll put here time before trigger, and I'm remembering what this is. Yes, I know what it is now. I remember what it is. I wrote these notes when we went through in the trading room one day, and we were just going through backtesting, and I just wrote a load of notes, and it formed perfectly for this webinar. Time before the trigger is, once you've got a setup, how long do you leave it? How many, like, let's say it's on an hourly time frame, how many hours do I give it before it triggers? For me, some strategies, if it hasn't done it in the next hour, it's run out of momentum, I'm not interested. Other times, or some other strategies, I guess, I'll take it as long as it's within my trading window, so between 8 and 3, for example. So I might also, I've got like a sub window that I'm not that interested in, between 10 and 12. So when I'm taking more discretionary trades, I'm generally not trading between that 10 and 12. The volume's dropped quite considerably, so I have these slots in the market that I'll trade in, and if it hasn't triggered by a certain amount of time, I'll just, in this case, I would just avoid taking it. Targets. Now this is the probably amongst the hardest part to actually get to when you're backtesting, and there are so many different sort of thoughts on this. firstly, do you take all or part of the trade out? If it hits a target, do I say, well, actually, I'm going to take half here, half there, and so on, or do I just take it at a specific point? Obviously, it's a lot easier just to take it all out at a specific point, and especially if you're trying to program anything like this, you're better off having the all. And then there's the, do I look for fixed targets or variable targets? The variable targets, what I mean by this is if I was trading to a moving average, for example, and using the moving average, or maybe even a pivot, if you're looking at different pivots over the days, it might become variable. Actually, pivots are less variable during each day or each period, so, and particularly the strategy I'm looking at here, they're fixed initially, unless you run out the end of the period and it runs through to the next, but generally, even then, it's still, for me, it's pretty fixed. But some things that are variable, like, as I said, moving averages, the thing, if you're using a variable and a moving average, you've got to consider that it's a diminishing return on something like a moving average, because the longer it takes to actually hit the moving average, the more likely the moving average is moving back towards price. So you're getting less of a return. So you've got to take that into account. Personally, having done a lot of testing, I find fixed is often on some strategies just perfect, because I measure, but I still, when I'm measuring for these targets, I measure. Let me give you an example. It's easier. So if I was measuring for a target, I would be measuring to see how far something went. So if I let's just say I saw this little price action here, it's a lower high coming in, I'm going to sell it. I would measure the full distance it made on each occasion. So if I had the same price action coming in, okay, it's a bit close here, but I'd measure between here and here. And I'd do that on, there's a higher low here, so let's say I went there, so I'd measure from here up to here. So what I can see in distance, and I'd measure those, and I'd recall how far something moved. That gives me a sort of an idea of the volatility to a degree, but you've got to remember the markets are always changing. However, that said, you do it over a long enough period, and you'll find that you get some figures. You'll get a yield curve effectively, and it's really interesting when you do these yield curves. I mean, there's one strategy, my AB3 strategy, I did these yield curves on, and that they just, however many years have gone past, the yield curve has been very, very similar. And they have and they're based on a multiple. Then, so I look at how far something can travel, and then I look at my risk and use that risk and divide, so I can find out, well, what's the multiple, so we can get the risk and the reward. Okay, so there we go, we got that part. Let's just move to next then. So fixed or variable targets. Then you've got to look at what you're trading on. Now, some currencies, for example, have different, they just move differently to others. Some of them, I mean, obviously the likes of the euro and the pound, they've got good liquidity in them. They can have good volatility, but the euro, even with all its liquidity, it has the liquidity, but it doesn't have the volatility at times. So you've got to look, and I mean, at times I scratch my head with the euro, because it's one of the currencies I look to trade quite frequently. And when it starts losing its volatility, in other words, when the average true range is what I'm looking at as a measure of volatility here, when that starts dropping down to a certain level, I've just worked out there's no point even trading it, because one, let's just say if I'm looking for a target of 20 or 30 pips in a day, yet it only does 40 pips in a day, well, it's okay if it's a strategy that's going to run into the next day, well, that's fine, and it may still pay out. But I still find that even if I'm looking for it to run into the next day, it doesn't get there because it has a much lower return effectively, and you might as well just not do it. So you need a currency that's going to work reasonably well. But then there's the other side of that coin, is where you end up with these pairs like the pound yen, which has a lot more volatility in it, and it might be too volatile. It may just have too much movement in it, so you're having these large risk levels. Okay, the returns when they hit they're okay, but often they're only as a multiple the same as if you were looking at the pound dollar. So people go chasing for points, but that's another matter, and probably a time for another webinar. But as opposed to the return, and return is more important. So which currencies, which assets do you, I mean, again, assets have they're different in terms of their nature. They move differently. You may be looking at oil, gold, whatever, but each of these things may have different characteristics. That's the word I was looking for. So you've got to decide on that and then start testing. The other important thing is that you don't, for currencies for example, is you don't do the same, have the same strategy clicking all at the same time across 6 currencies, because otherwise you'll be putting risk in at the same time. So you've got to look at the timing of how things develop, and so ideally if they're very correlated, like the pound is very correlated with the euro often, maybe just do it either on the euro or the pound, and look at pairs that are less correlated. A question which I'll leave for you is trade through the news or not. When I very first did some testing, I literally ignored news or anything else. I looked at charts with nothing else on them apart from what I was measuring, and I had nothing else. I never went through. What I've seen in terms of trading things live sometimes, though, it's in the principle of not worrying about news is one thing. The thing is, when the news starts getting particularly volatile, it can kill your trades too quickly. So it might be wise saying, well, actually, I'll keep an eye on what news is coming out, and I have sort of some criteria of news events that I won't trade through, for such as non-farm payrolls, the central bank meetings. In fact, non-farm payrolls is a quick switch on, switch off situation, or switch off then switch back on at some stage, because it has a smaller window. If it's data that is just coming out and it's there, then that's fine. Where you've got like meetings being held and you've got different comments coming in, they're much more difficult to try and trade through. So they're probably best not traded through anyway. But even these highly volatile news events are probably worth missing, as I say. But probably there's about 5 or 6. Okay, the number for the example in terms of when you are testing, how many do I include in the example? It's 2, 3, no, 20. Well, it starts building an example. I think when I remember back to my days of statistical analysis, there used to be a sort of like a minimum number of about 30 that started to become anywhere near statistically right. But in reality, you don't, that might be your Q&D, your quick and dirty sample, and it's a sample that in that case of just taking 30 trades backwards. But then you need to make sure you're not curve fitting. The biggest problem people have in trading currencies and looking at currencies is the curve fit. It will vary quite considerably. You'll go through periods when the markets are very volatile and other periods where they're really compact and consolidating and not going anywhere, it seems. So you've got to ensure that all of those factors are taken into account when you're testing. So you need to test back more than a few months. You need to test back over years ideally, and even if you don't do the full year but you pick parts of a year. But there's times like when Trump was around, for example, the volatility on some of those years was quite high at times because he moved the markets a lot more. At different sort of major events where you've got a lot of speakers suddenly coming out, you get this greater volatility. So you need to be able to ensure that your test covers these sort of periods. So I'd really recommend, if you don't go through it for X amount of years, 2-3 years backwards, you at least take a sample when you can see the different volatility in the markets and check it out. The last and the most important thing is, does it work in real time? Because a lot of people come up with these lovely things, and they often design these flashing lights and whatever, little colored codes and things, but does it work in real time? And that's the important thing. Can you trade what your setup is in real term? And that might be a case of, well, you can do it at a very early stage, so you don't have to go through 5 years of back testing. You'll have an idea, then just start looking at the charts and just seeing. You don't have to put real money or any money on it. You could just say, okay, right, I would be buying here, and then see what happens, because it's very easy to be, when you've got a lot of chart in front of you, to be guessing what you're seeing. Or think, oh yeah, well, it did this, so I would have done that. Well, that doesn't happen in real time. Real time is just that. It is real, and I mean, to press the button, you've got to have something that you're sure of. And if you're not sure of it, then you need to go back, test it some more, or you're not going to be trading with that strategy. You have to have complete confidence in what you're doing, because otherwise you'll snatch at profits too early. You will get in the trade too early or too late. Often too late. People will just wait and wait and wait, and it's halfway to where it should be in terms of their target, and eventually they get in, and of course it distorts the risk and the reward. So everything has to be tested in real time. And this might be after you've gone back and tested about 30 examples, and you just think, well, okay, I've got enough, a bit of a starting point here. Let me try that and see what happens. And yep, okay, I can trade it. Yeah, it feel confident enough, and then you just sort of go right the way back and start the number crunching for real. Now, some of you might be using software. If you've got software that you're using and you find particularly good, let me know. Some of you won't be using software. Personally, I'm quite happy using paper, or I'd just chuck it on a spreadsheet. The one thing an automated system will never show you is what happened aside of what was happening. if you're with me, it'll only show you black and white basically. Whereas in reality, there might have been something in there which it might be a news event or something. It won't be telling you when news events are coming through, so it will just test warts and all, which is an okay example. And I started off with that on a couple of strategies I did. I just didn't look at where the news is, but there's ways of finding when news is coming out very easily, or what came out, you should say. So this is where we got. Let's just go through the example, and I can sort of maybe bring some of these into life in terms of what we're doing, and I'll put it together in terms of building the strategy together. So if you remember rightly, what I said is in the first place, and you've got to have the idea. So the idea is where the probability is high that either the R1 or S1 will get hit. Why might it do that? Well, statistically it does it. So there's the why behind it, but also the price will move. You've got to be careful, because a lot of the time the price action will stay within those ranges. Other times it will be flying along and just run out of there. And when you're looking at pivots, for example, there'll be times when the pivots get so pinched it's quite ugly. So you've got to take that into account. However, and there may be days like this when you can see this like this, when as I said before, you just won't be able to trade it. Is this nothing? Look, there's the R1. That's it. Now, of course, the question comes in, well, how about the R2 on that day? Well, you test it. just test it. Have some criteria of why you would have brought the R2 into play, or R3. Okay. So there's the basic reason. Initial rules, for me, it must hit the daily pivot first, because the daily pivot has somewhere between a 75 and 80% chance of being hit. So it's got a reasonable probability of being hit. So you need to know it's done that first. So there's a rule that's sitting around there. And then I want to be ideally trading. If it's trending, I want to be with the trend. On this example here, really I want to be trading with the trend, although there is a reason why the trend's changed a little bit here, and I might accept that. Well, okay, the trend's changed, it's put a lower high, whatever it may be, you've got to be reasonably consistent with it. I can read price reasonably well, and I'm quite happy with reading price, and I can be pretty consistent. All you've got to do in this case is look for a reason to be trading it from away from the pivot to the R1 or the S1. Is there a good enough case? Once this market has got quite choppy here, there's a reasonable case that the market's choppy and you can trade it. So you've got some initial rules here. What do you measure? Well, you measure where you're going to be placing stops. In this particular example, I've got to work out how to place stops. So it's quite simple for me in this particular example, because if I'm looking at it running from a pivot to it's either it's S1 or R1, the S1 in this case, well, I'm looking for the entry. The entry would give me the ideal stop placement. I'm going to cheat a little bit on here, as I did on the video I did for YouTube, in terms of taking this bar, this 7. Well, actually, I don't need to cheat too much because that was a 7 o'clock bar. You could. Now this is where there's so many different entries. And I was thinking that earlier on when I was preparing for this, was perhaps I could just do a little session on entering trades at some stage, getting the entries, because there's so many different ways of entering a trade. For example, here I could trade it when it hit the pivot, when it broke through the pivot, when it hit the pivot and went in the direction I thought it was going to. It's put a lower high in here, so I'm expecting it to drop. So am I going to be putting it wait for it to come, just retrace and go? More conservative approach is one I prefer here, in terms of let's get this bar in, so the bar's in, or the lower high when it's actually making yet another little lower high. So I'm sort of reading the price. Just wait for the bar to finish maybe, and then I've got to stop. So there's my stop placement, would be above the high there. It would have to be above the pivot, and then there's my range for the risk, plus probably a pip or two. Let's say 2 pips for a moment. So I'd know the size of the risk, and then I'm looking at the targets. Well, the targets obviously are the R1 and S1. So obviously not quite so obvious, because let's take into account a precision. You might just see that this one here actually hit it at 3 o'clock in the afternoon. One thing to bear in mind, it didn't actually hit it, it came slightly short. And when you're setting targets, I would suggest that you aim, and firstly you've got to realize you're looking at the bid and ask. This is only showing the bid prices, so you're going to be closed out, you're going to be buying at the ask. So you need the bid to have gone through the pivot to have, unless you've got very zero spreads, you're going to be needing the pivot to have gone through. So you need to leave 2 or 3 pips depending on the size of your spread when you're looking for your targets, and you'll find that you just got a better probability, because otherwise this might have hit here or just came a bit short. You've got the target set on the pivot itself, and what you haven't realized is, well, hang on a minute, it's bid price and not ask price. I get closed out at ask price, so the bid needs to go lower. Okay, so we're starting to build up the plan for it in terms of initial rules. What am I going to measure? Well, I'm simply measuring the from where I can get into a trade. There's this example here. How do I get into a trade? Well, you can. The other thing is in getting into the trades themselves. Sometimes it's easier than others. This is just okay. You could say, well, it's broke back above the pivot here. I'm going to use that with a stop below the lows there. That's my measurement. There's the target. So you could do it like that. But you can use multiple time frames, and I recommend you sort of look at multiple time frames. Let me just bring in another. If I can bring it in. There we go. Where am I? Is this the 20? Yep. So this was that retracement that occurred, and again you could be looking at saying, well, this is the 4-hour pivot here on this particular occasion. I've got 4-hour pivots shown compared to a daily pivot. We could be looking for the higher low, looking at where that comes. I would look at the short time here and just say wait until it's broken back above its 8 and 21. So just check that it's back above its 8 and 21 and above the pivot. So it's above the daily pivot here, so it's moving back into bullish territory, for example. So that's, as I say, get the entries maybe a little bit, particularly in this case, a bit more discretionary. You've got to have an understanding of how you're going to get in. But then it's got a fixed stop, the lows here, and it's got a fixed target. And if it doesn't get hit on this day, perhaps it might get hit on the next day. So I would leave it. Some people might say, well, actually, it's only a day trade. If it doesn't happen today, I'm out. Well, this one got hit, obviously. Yesterday, there we go, we had the outside bar. So it could be a play on the outside bar there, a couple of pips below. Does it work? You need the stops above the high there. And you're looking for the S1. Does the risk reward work? You've got to measure that. So that's the sort of the basics behind it there. It's not totally mechanical. It's got mechanical exits. So parts of it are exits. Stop rules are pretty simple in terms on this particular case. It's by the recent lows for me. Entry rules a little bit more complex on this because it's discretionary. Trading times, well, there you go. I'll put trading times in here. I'm really looking to trade, as I said, for me personally, I'd be looking between 8 and 10 to actually get into a trade. So this one, yep, it's gone, but it's after 10 o'clock. So it's lovely as it's gone. Wouldn't necessarily want to be in there. It's just proving me wrong here, of course, because it's what's on the chart. But you choose your own. I mean, maybe you just say, well, actually, I'm quite happy between 8 and 3, full stop, and whatever you've chosen though. How long before trigger? Well, if it's running, find one that's running through its pivot all day long, like this one here. I can't even see an entry on here, discretionary or not. And the targets are so close anyway. It's probably going to be. I'm looking at what was happening. It's sort of starting breaking down, pull back up here. So you might take a really aggressive. It's 11 o'clock. Don't like it. 12 o'clock on the break of it, possible. But then you're looking at the measurement down there. To me, it's a long time. It's well into the day before it started to trigger. So maybe I think, well, do you know, if it's not happening by a certain time of the day, maybe it's just not going to happen. And you've also, well, hang on a minute. You should also take into account news, because it might be the next day there's a big news event coming out. So on the 20th of May, for example, there might be a 21st of May, there may be a news example. Talking of news, I'll just run that through with news. If you use Forex Factory, you can actually go back to the date of any news. So the 26th, you can see what news came out, and you can go back on this for years. It's brilliant, and that's why I like it, because the news is always there. It's got the forecast actual, so you can see what was forecast, what was in actual in there. But it's an absolutely brilliant tool to understand what news was going to come out, so you can plan. You can actually say, well, okay, on that day I won't take the trade, so I won't measure it, or I'll keep a sub measure. What I tend to do is I'll have an Excel spreadsheet of all the days I'm trading it, and then those that I've discounted because of news, I'll put on a list at the bottom. And it might be by the time I've finished, when I'm looking at all those news days, well, actually it's just as good on the news days as it is vice versa. Just chuck them in because it's all part of the stats. But yeah, any day you like on here, you can go back and see what the news was like. So what day am I looking at here? 20th of the 5th. So go back to 20th of the 5th. That was a Friday. Sleepy old Friday. No news coming out whatsoever. So it might have just been a sleepy old. Well, it was a sleepy old Friday. I remember it well. Just nothing really happening that day. And it's got no news coming in the next day. It's actually the next week we started seeing a bit more news as it's coming through the day, through the week. Actually, no, we'd just got over a whole raft of different numbers coming out that week actually. So it's just consolidation. But you can, as I say, go back to and check, and you can, as you're testing, just just look at each day as you can't it go through, so you can just click on it for that day or period. I'm saying day here, but you've got to address it in terms of when you're going to be looking to take it. Okay, so time before trigger. What else when we're looking at their targets? Well, the target is very simple in this particular case because the targets are the R1 or the S1, and as I said, it's a couple of pips above or a couple of pips below would be the actual exit point. Which currencies? It's funny actually, I'm starting to look at this a bit more, trying to get it a bit more mechanically. It's quite difficult, but I've been trading a principle behind this for years, and I tend to trade it in trends, so it's got certain principles that I sort of follow and like the look of. There's certain currencies I tend to like, intraday currencies that I'm not for intraday, like the Aussie New Zealand dollar. If you come back to look at something like this, it can get in, it's very correlated, so a cross pair like that might not be the best to be running on. The Euro CAD, for example, at the moment is one of my favourite currencies. It's great for an intraday and end of day and swing, well, more swing trades I'm looking at often. If I come back to a weekly and show you, it's been in such a beautiful trend for such a long time. It generally makes for a decent trade. So yeah, I'm looking at something that's given me the opportunity to do something. So, but then I'll look at another currency once I've done the testing on the first one and start building up a little bit. On some strategies, I just found the pound just doesn't work particularly well. On other strategies, I find the pound is the best one at it. So it does depend on the strategy a little bit. As I've already covered, news, no news, we've covered that within what I'm looking at here. Numbers in the example, you need to, something like this, go back quite a long way, and it might be stretched to how far you can go back depending on what software you're using, but it's worth paying for the extended data on whatever software you're using. I mean, I use eSignal, but I still pay for, I think I've got 10 or 20 years back data on the short time frames. It's the shorter time frames that I'm wanting the data on, and it gives me it right the way back 10 or so years, or additional years to what they cover. So there you go. That is pretty much an example of what you might be measuring. It's an example. It's clearly shown you what sort of things you should be looking at to measure. I'm sure there's other things. Open for questions now, because I'm just about done on that. I'm not going to cover it anymore, because you can go back and have a look at it and take your own examples and do things with it. I'm quite happy now to open the room. So questions, anything that you want to cover in the future, just start firing them away. The sooner the better, because then we can zip off and go and look at those gardens. Apparently there's beer somewhere. Oh no. No questions? It's all very, very quiet. I'm waiting. Anything you'd like to be covered next time? This has been recorded, by the way, so it will be on YouTube almost immediately. Okay, if there's nothing coming through, which there doesn't seem to be, you can all ask questions. If there's nothing coming through, I'm going to end it around about here, but do email me, kim@thepivottrader.com, if you've got things that you want covered. If there's anything else that any questions regarding this, I'm quite happy going back through them with you. Let me know what sort of further subjects that you, as I say, you want covered on these. But otherwise, I'm going to end it here. You all okay? There's no one talking to me at all. I've got no, not a single. Nothing at all. Okay, fine. On that basis, I've either got you all switched off so you can't talk. Yeah, Robert over the other side there. backtesting behavior in a trade is something I need to look at. Yep. One of the things just on backtesting is to bear in mind that you if you do it and you've done it yourself and you've seen the numbers and you've seen the charts, when it comes to trading it, if you're trading it manually, you have the confidence to press the buttons a lot easier. If you just accept what you've been told by somebody, this is a great strategy. The amount of great strategies that are available out on YouTube and are absolute dog muck, I think is the word I was going to use. They're absolutely rubbish. I wouldn't touch them with a barge pole. They're old thoughts. They're risky. They're okay if you can see the chart beforehand. They just don't work. A lot of them. So many people say, "Oh, look, I've got this great. What do you think of this, Kim?" And I'll have a look at it and I think, that's no good. And the other thing is, so if you're just, but some people get drawn in. I've got some members of the day trading room at the moment, and they spent a lot of time on YouTube, and that's where a lot of people learn these days. And they'll take their learning from there, and they'll be thinking, well, this is absolutely brilliant, and go and try and trade it. And as I said, if you can't live trade it, because when you come to live trade anything, if you haven't back tested it yourself, you get the jitters anyway, because you're not so sure. So what I've done here is taken a whole subject and not talked about the psychology of trading it, and that's probably the biggest thing, and that's the biggest gain you'll get out of taking a chart back for a year and sitting there. And I know it's that plodding, and during the summer you don't necessarily want to be doing it, but during the winter you've got no excuses. So anyway, I'll get off my orange box, and I'll wish you a great Saturday. It's 9:52. I'm going to call it a day at this point here. You go out and get those flowers watered, grass cut, barbecue's ready, and I'll catch you soon.